Chapter 2. We begin by analyzing business transactions. So our learning objectives: state the basic accounting equation and describe its relationship to the balance sheet. Then look at business transactions and determine their effect on the financial statements. Recall that assets are things owned by the business. Equities are claims to or interest in those assets. For example, assume you purchased a new automobile for $15,000 by investing $10,000 of your own money and borrowing $5,000 from a bank. Your equity in the automobile is $10,000, and the bank's equity is $5,000. You can further describe the $5,000 as a liability because you owe the bank $5,000. If you are a corporation, you can describe your $10,000 equity as stockholders' equity or shareholders' equity, or interest in the asset. Since the owners of the corporation are stockholders, the basic accounting equation would then be assets total $15,000 equals liabilities total $5,000 plus shareholders' equity $10,000. Now, an accounting transaction is a business activity or event that causes a measurable change in this accounting equation: assets equal liabilities plus stockholders' equity. An exchange of cash for merchandise is a transaction. Two things happening. Somebody gives you cash, you give the customer merchandise. An exchange takes place at an agreed price, and there's an objective measure of the value of the economic activity. For example, the objective measure of an exchange may be $5,000. These two factors, evidence and measurement, make possible the recording of the transaction. Merely placing an order for goods is not a business transaction because no exchange has taken place. Now visually we can expand the accounting equation: assets equal liabilities plus shareholders' equity. Assets are things owned by the business. Liabilities are people that the business owes. The equity now is in two parts. One, common stock. That is what the shareholders invested in the business. That's the value of their investment. Plus, what belongs to shareholders' equity are all the earnings that the business has earned and has retained, actually. Now, this retained earnings is a function of the operations of revenue, the transactions that involve the business earning revenue, minus the transactions that involve the business incurring expenses, and also minus any payment back to the shareholders. So there are your types of account. 1, assets. 2, liabilities. 3, equity. 4, revenue accounts. 5. Okay, those are basically all business transactions fall into those 5, 1 or 2 of those 5 categories of the balance sheet equation. To demonstrate now, let's assume a transaction. On March 1st, cash of $10,000 was invested in this company, Vincent Corporation, by the investors in exchange for $10,000 in common stock. That is, the business sold $10,000 worth of shares to the investors of the corporation, and the investors gave the business $10,000. So keep in mind, we're recording the business transactions of the entity, the business. So the assets go up by $10,000. That's reasonable. No liability. And the shareholders' equity goes up. So you see, what we have here is the equal sign. There's an increase on the left part of the equal sign, and there's an increase on the right side. So this is balanced. Now, on that same day, the company borrowed $5,000 from the bank by signing a note. We'll talk about what a note payable is later. So they received cash, but now they owe the bank. So the transaction can be recorded as a plus $5,000 in the cash account and a plus $5,000 in the notes payable account. Again, an increase of $5,000 on the left side of this equal sign and an increase of $5,000 on the right side of that equal sign. On March 2nd, the company purchased equipment by paying $5,000 in cash. Okay, there's an exchange here. I've bought equipment, I have equipment, so my equipment account goes up, plus 5,000, but I paid cash. My cash account goes down. Notice a negative and a positive both on the same side of the equal sign, so the balance sheet equation is still in balance and will always be in balance if the transactions are recorded correctly. On March 2nd, Vincent received $1,200 cash advance. Now this is a particular type of transaction where a client has paid the company to do or perform a service, but the company hasn't performed the service yet. But they have a liability to perform that service by accepting the cash. So the two accounts are cash goes up, plus 120, and we increase an account called unearned service revenue. Because we accepted the money, we now are obliged, we have a liability to provide that service. Again, an increase plus on the left and an increase plus on the right. March 3rd, Vincent received $10,000 in cash from a customer for whom we have performed services. So anytime we perform services, we increase revenue. We've earned revenue when we perform the service. And in this case, we receive cash. So the two accounts are cash and revenue. Cash goes up because we received it, and revenue goes up because we've earned it. March 3rd, we paid office rent. Now this is an expense that was incurred in order to earn my revenue. And so therefore, here we have an expense which will decrease retained earnings, so we make it negative 900 because expenses decrease retained earnings, and we paid cash. So again, we have a negative on the left side and a negative on the right side, and we are in balance. On March 4th, Vincent paid a 1-year insurance policy that will expire next September. So now we've purchased an asset, a 1-year insurance protection, and we paid $600 for it. So our cash goes down $600 because we paid it, but we have an asset now called prepaid insurance, so it goes up, and there you have a negative and positive on both sides on the same side of the equal sign. Sorry about that. On March 5th, Vincent purchased supplies on account from Aero. All right. On account means I have an account with this company, and I bought supplies, office supplies. So therefore, my asset office supplies goes up because I now have acquired them, I own them, and my liabilities go up because I own the supplies, and I now owe the supplier the money. That's how I record it. Plus on the left, plus on the right. Now on the 10th, Vincent pays a $500 dividend. Now a dividend is a repayment to the shareholders of the earnings the company has made. And so therefore, it will reduce shareholders' equity because I am paying back the shareholders and I pay them with cash, so my cash decreases. Again, negative left, negative right. And lastly, the employees have worked for us for 2 weeks. We pay them at the end of 2 weeks. They've earned $4,000 in salary. So therefore I pay them cash. So my cash goes down, $4,000. And this is an expense of doing business. So my expenses go up actually, but because it's a negative, because it reduces retained earnings, we say negative. Now that completes all the transactions. So now we simply add them up. Plus 10, plus 5, minus 5, plus, minus, minus, and I get 15,200 in cash. Supplies, 2,500. Prepaid insurance, 600, and equipment, 5,000. My total assets then, 23,300. On the liability and equity side, 5,000 notes payable, 2,500, unearned service revenue, plus the common stock. Remember the first transaction, put the money in, plus the money they earned in revenue, minus the expenses they incurred, minus the dividends, 2330. So you see, the balance sheet equation remains balanced. And every transaction was an exchange between two accounts, and the result of that exchange is that the balance sheet equation, assets equaled liability plus shareholders' equity.